Good morning and welcome to this Wednesday, September 2nd, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, as I get up just about every morning, I feel like it's Groundhog Day if you ever watch that movie with Bill Murray. Just every day seems like the same day over and over again. Which from a bullish perspective is great news because the market futures once again up, NASDAQ more than 100 points this morning, the Dow up over 100 as better and better economic reports come out. Looks more and more like a V-shaped bottom in the economy. That's what the stock market's been telling us really for the last 5 months since we bottomed. We came roaring straight back up. And so the market's been predicting a V-shaped recovery, and we're starting to see it in terms of economic reports. And overall, I think the market is just looking to go higher. And we're going to get into all of that in just a moment. But before I do want to just point, especially our newer listeners and viewers, over to earningsbeats.com. Learn to trade better, learn to evaluate the market better. You can do that by subscribing to our free Earnings Beats Digest newsletter. All it takes is a name and an email address. Hit that subscribe button, and you'll be set to go. 3 times a week, we reach out to our community. Could be something with the overall index. We did that on Monday in terms of the S&P 500. But a lot of times it's individual stocks. Got a short squeeze candidate that we looked at for this morning. So we do provide some trading opportunities for our community members as well. And it's really about learning our methodology. We talk about earnings, we talk about relative strength, we talk about the different types of trades, trading strategies like the short squeeze. Try to hopefully teach a little bit about discipline, patience, allowing markets to come back to you, allowing stocks to come back to you. I know that's a difficult concept in this market when you're looking at stocks like Apple and Zoom and Tesla and companies that seemingly don't pull back. And, those are the exceptions. We don't have a lot of companies doing that. We got a lot of rotation in the market, which is what you look for as a trader. But anyway, we go through a lot of those different concepts. So we'd love to have you join our community. Name, email address, hit that subscribe button. You're good to go. If you want to try our service, I tell you, there's never been a better time. Hit that join today button. We'll go through, provide you some of the things that you'll get in the service. It's $7 for 30 days, and we'll even refund you the $7 within a week. So it's literally zero cost. And if you go down here and look at these portfolios yesterday, my gosh, what a day on the model portfolio, all of our portfolios, but especially model. Now the model since November 19th of 2018 is up 164%. The S&P is up 31%. That's 133 percentage points higher than the S&P 500. 80% of mutual funds, I think since the 1980s, I think the number's somewhere around 80% of mutual funds have underperformed the S&P 500. We are crushing the S&P 500. And I'm proud of this performance. And the whole idea is really to stick with leading stocks in leading industry groups, equal weighted, and you just simply, every 90 days, go with different companies. Sometimes the same companies, move on because they've remained so strong. But the whole idea is to reevaluate every 90 days and just stick with that. Our aggressive portfolio doing very well. It was off to a rough start this quarter, but it is starting to bounce back a little bit. Strong AD, though, now is up in just, we started this May 19th in the middle of a pandemic, and the strong AD portfolio is up 30% since May 19th. The S&P is up 20%, but still, that's an additional 10 percentage points. And off to another great start this quarter. So if you want to check all this out, go over to Earnings Beats and make sure you sign up. All right, let's get into what happened on Tuesday. We had the market moving higher again. No bifurcation this time. Everything was going up. We had the Dow Jones up 0.75%. S&P, same thing, back above that 3,500. Remember, we were struggling to get back up to 3386, the February all-time high. That is now quite a bit in our rearview mirror. 3526, the S&P. I made a pretty bold call back at the beginning of the year. We had an event beginning of the year, Market Vision 2020. We had some of my fellow colleagues over at Stock Charts join us, and one of the things we talked about was our, prediction for 2020. And at the time, I was very serious, and I said 40-40. I thought the S&P 500 could get to 40-40 in 2020. And when the pandemic hit and we went back down to 2190, didn't seem like it was really anything that was even remotely possible. But here we are, S&P 500 at 3526, and we still have the most bullish quarter of the year ahead, the fourth quarter. I could see 4,000. I might still get that 40-40 prediction. But anyway, S&P 500 now 3,500 and above. NASDAQ on the verge of 12,000. NASDAQ 100 already went through it. And with today's futures, we're probably going to be above that 12,000 level on the open. NASDAQ just continues to move higher and higher. A lot of folks shaking their head, don't understand this. I can tell you, strong earnings growth, a strong economy, and record low interest rates, those combinations, that's nirvana for equities. And the market's beginning to realize it. Just take a look at that Zoom video communications earnings report, where they blew their numbers out of the water and the stock went up 40%, 35, 40%. That's what the market's catching up with. The market's finally realizing that, hey, we got strong numbers on our hands. And in a low interest rate environment, where else are you going to put your money? 10-year treasury yield? Really? 0.7%? When you've got companies like Zoom doubling and tripling and quadrupling earnings estimates, raising guidance. Zoom raised guidance not only next quarter, but next year. That's how you build valuations, because now Wall Street's got to go in and change their models. They've got to go in and change their growth forecasts for these companies. And then discount those future higher earnings using a really low interest rate. Valuations go through the roof. Anyhow, mid caps, small caps did well. Materials broke out again. Think bull market, think wide participation. Materials moving up, technology leading everything to the upside, along with consumer discretionary. Industrials also did well, performing well. On a relative basis, they're not performing well, but on an absolute basis, they're moving higher. They're above their 20, which is above the 50. Utilities weak. This was the group that was down more than 1% on Tuesday. And, they're still going higher. I mean, you've got higher lows in play, kind of equal highs. Eventually, I think utilities break out, but it comes down to, can you outperform the S&P 500 by owning utilities? A lot of folks, their argument is, well, I want to be diversified. Hey, if that works for you, that's fine. In my view, as a short-term trader, always evaluating the market and constantly, with no commissions trading, you can always switch at any moment. So if you're in a position like the XLU, which has been underperforming the S&P 500 for months, why keep doing it? I mean, all you're doing by diversifying, in my opinion, is lowering your return. I just stick with what's winning. I mean, look at discretionary and technology, or even materials, and compare that to what's going on in utilities. Even look at industrials. There are just so many other places that I would rather have my money working for me than in utilities. Now, are there a couple of stocks within utilities that are performing well and able to outperform the S&P 500? Sure, but you got to get those couple companies right. If you don't, you're going to underperform. The other industry groups, other sectors, many of those have so many companies that are outperforming. It's harder to miss with an individual stock. You can still miss, believe me, but it's harder because you got a lot of companies outperforming. All right, 10-year treasury yield. First of all, we had the August ADP employment report out this morning. Number came in below expectations from what I saw. It was just a quick glance. I'm much more interested in the non-farm payrolls on Friday. I've seen so many, ADP reports come out on Wednesday and then everything gets totally flipped on Friday. I want to pay more attention to what comes out on Friday. But we're almost in one of those situations where bad news is going to be good news. If the jobs report falls short, then there's clearly no expectation for the Fed to even consider raising rates. And if the report comes out strong, the Fed's already come out and said, well, we're going to wait and see if inflation picks up even beyond our target before we'll consider raising rates. So I don't really see a bearish situation in terms of jobs. I don't know how the market's going to interpret a jobs report to be bearish. I don't know. Maybe I'm looking through those rose-colored glasses because I do tend to be very bullish. for the most part. And the market backs me up on that, by the way. The stock market goes up a lot more than it goes down. So I think, you got to pick your spots when you're bearish. Let the market tell you. Don't try to tell the market. When the market's in a runaway move to the upside, don't try to tell the market that it should be going down. The market is telling each of us that it's going up, whether we want to be on board or not. That's the difference. I mean, you can't impose your will in the stock market. I learned that years ago. Every once in a while, I still have to pay that tuition, and it's not fun. It's much better just to listen to what the market is telling us. But there you can see the 10-year Treasury yield. We have pulled back the last few days, sitting just above that rising 20-day moving average. I mean, I'd like to see this hold and move back to the upside. But I think we've already proven that the market can go up even without money rotating to from the Treasury market. So I think if we go higher in the yield, then that's going to help the stock market go up faster, but it's not necessary for the market to go up. In a secular bear market, 10-year Treasury yield goes down, stock market goes down with it, probably even faster. But in a secular bull market, this just means maybe a little less robust move to the upside in terms of equities when the yield's not cooperating. If the yield does cooperate, that's when we could see a really big move. Later this morning, we'll get July factory orders, looking for a 6% rise. Again, that'll be out at 10 a.m. June, by the way, went up 6.2%. Factory orders, 6%. They're coming back. The economy's coming back. It's what the stocks have been telling us for months, and we're seeing it. The jobs are coming back. Your unemployment rate's not going to go from where it was back down to 4 or 5%. And, it's not going to happen overnight, but we're making our way back, and the market's looking ahead and it likes what it sees. Also later today, Beige Book. Beige Book will be released at 2 p.m. If you're not familiar with this comes out 8 times a year. It's a report on economic conditions, and it's used by the FOMC when they, make their policy decisions on what to do with rates and so forth. So 8 times a year, there will be one federal district bank that compiles anecdotal evidence on economic conditions and reports, and it comes out in the Beige Book. And so everyone kind of gets an idea. The Fed, I think, tries to be transparent. And so everyone can get an idea of what the Fed's likely to do. I think most of us realize the Fed's not going to do anything in terms of raising rates. That's not happening. And they're on record saying that for the most part, next couple of years, it's a free pass. And that's why I think this market, which has been soaring, continues to soar. I think as the economy picks up, these companies that are reporting great earnings growth, Apple, Zoom, Tesla, as the economy picks up, their earnings are going to do nothing but go higher. And they have a history of outperforming estimates. So these are companies that you want to own. I know it's hard jumping into any stock after it's made a big move, but at a minimum, think about getting in over a period of time. Some of these stocks are great companies to own, and I think will be for years to come. All right, moving on. Let's take a look at AMC. They reported that they're going to be opening or they're going to be resuming operations at another 140 locations later this week, which brings them up to 420 now that are open. And I believe later this week, they're going to begin opening some locations in California. So you can see the stock starting to move up. Accumulation distribution, which all the way through, you can see just kept getting weaker and weaker. We're actually at about a 3-month high now on accumulation distribution. So we're starting to turn up. Look at the volume coming in on this move to the upside. The stock, I think, I can tell you, pull it up and see what it's doing in pre-market. Yeah, it's up another 15% this morning on this news. So it's now up to almost $7. So we're going to get a nice little gap up. And I think the big challenge is going to be on that June high, which was at $7.30. So about a week ago, we got up to $7.10. Didn't quite get to $7.30, but that $7.30 level I think is going to be important. And we may challenge it today. Good news coming out. I mean, the stock, which obviously was one of the most hurt during the pandemic, I mean, movie theaters, not a whole lot worse than being in a movie theater with a pandemic, a 100-year pandemic going around. So, I mean, the company which shut down now starting to strengthen, and we can see that in the charts. All right, let's move on to some of the stocks that just absolutely will not let up. Apple. I saw that their target was raised from 115 to 150. I don't know who, I can't recall who raised their target, but that was yesterday, and you could see the stock taking another move to the upside. I mean, you look at some of these moves, and Apple, the stock literally 5 weeks ago was trading under 90. It's up 50% in 5 weeks. Usually you think big companies are slow movers and they can't really grow very fast. And, so you're going to plod along. Not with Apple. I mean, Apple literally 5 weeks ago, stock's gone up 50% in market cap in 5 weeks. I would have, if I hadn't seen it with my own eyes, I probably would have thought it never could have happened. Zoom says, hey, I can top that. I can go up 40% one day. Big earnings report. Like I said, just blew estimates out of the water. Revenue, earnings, raised guidance for next quarter, raised guidance for next year. Is Zoom going to pull back after this big gap up? Are we going to come back down and test that gap support at 325? It's possible. I mean, who's to say what might happen in September? September's a kind of a rough month for equities normally. So would I be shocked if we came back to 325? No. Would I be shocked if we went to 600, 700 before we came back to 325? No. Would I be shocked if we never come back to 325? No. I think that, these companies that are growing earnings in a runaway secular bull market, these are leaders. This is why our portfolios do as well as they do, because we get in leaders and we stick with them. We don't try to use our emotions to say, hey, this stock's gone up too much. It can't go up anymore. It's gone up too much. That's not a good argument. It's really not a good argument. I mean, did you say that about Zoom 6 months ago? Did you say it about Apple 3 months ago, 6 months ago, 3 years ago, 10 years ago? You're just constantly saying it can't go up anymore. I'm not going to own it because it can't go up anymore. It's already gone up too much. I can't get in now. I mean, I agree. It's better to get these stocks on pullbacks. But when is that pullback going to come? I can't tell you. I wish I could. If I knew for sure, I'd tell everybody just to get out and we'll get back in when, my crystal ball comes true. But I don't have that crystal ball. What I do know is that these companies are favored on Wall Street. They're leaders in their industry. They are benefiting mightily by this comeback in our economy. And these are companies that you simply want to be in. Netflix. When Netflix wasn't performing very well, it's probably back in July maybe, or maybe it was early August. I said, just have patience. Netflix will be back. Well, we've had a couple of days. Yesterday was another day, up 5%, another $27. We're on the verge of breaking out. I mean, I could see off of this move to the upside. Maybe we pause at 575, pull back one more time, maybe an ascending triangle forms or something. Or maybe this is just a little cup and we go sideways for a bit with a handle. Eventually, I see Netflix breaking out. And, look at some of these stocks when you do see these moves back to the upside. Check out what's going on with accumulation distribution. This isn't my primary indicator, but it is definitely a good secondary indicator. So in other words, if I'm looking at two stocks, one like Netflix, which is going up, and the accumulation distribution is going up with it, maybe even breaking out before price breaks out, to me, that's a much better signal than maybe another company that has a similar looking chart with an AD line that's going down. I would be more concerned. It doesn't mean I wouldn't buy the stock with the AD line going down, but what it does mean is that it could be a sign of distribution. I want to make sure I have my stops in play. All right, DocuSign. I believe they report later today. I didn't look, but it's either today or tomorrow. I think it's today after the bell. Broke out. I mean, Zoom just opened the door for a lot of these companies literally to zoom higher. DocuSign, one of those. Up 20% yesterday in one day. The market is realizing the strength of these companies, the paradigm shift. This is what I talked about back in March and April when we started our strong AD chart list and we saw all these companies being accumulated, even though prices were going down. Look at DocuSign back in March. Prices were going down, not as bad as some stocks, but we were getting these gap downs. But look at some of these hollow candles. The stock was actually breaking out to new highs in the AD with prices going lower. It was a paradigm shift. Wall Street knew it. The media wasn't going to tell you about it, but Wall Street knew it. So when everybody was selling, Wall Street was like, no, I don't want to touch the airlines. Nope, don't want any cruise lines. I'm going to forget about hotels. No gambling stocks for me. I don't want, I don't want AMC, the theaters, but give me a little bit of this DocuSign. I'll take some Zoom. I'll take Peloton. These are companies that benefit from a paradigm shift. This isn't something that's going to go away. The virus is going to go away. I don't think the paradigm shift is going away. I don't think DocuSign's business is going away. I don't think Zoom's business is going away. A lot of employees really like this whole idea of staying at home and working from home and having online collaboration. This is a major change to what we can expect over the next many years, the next decade. I mean, if you're looking at themes that are changing our investing world, you're looking at them. DocuSign, Zoom, Peloton, even stocks like Chewy's, the pet supply company delivering to your home, Amazon, Apple, Tesla. I mean, these companies are all absolutely killing it with their earnings growth in a low interest rate environment. So anyway, DocuSign reports, are they going to go up 40% with their earnings like Zoom did? I don't know. I do believe they're going to have a great report, but it's always difficult to say what the market reaction is going to be. What if they come out with a great report and for whatever reason, stock pulls back to 220? Would I change my mind on DocuSign? No, I'd want to buy it at that gap support. I'd love to buy it back at the 20-day moving average. It's not going to change my mind at all, especially if the report's good. Sometimes there's just a lot of good news already built in. So it's a buy on rumor, sell on news kind of scenario. So even with Zoom, I didn't know. I had a pretty good idea Zoom was going to report awesome numbers. I didn't know how the market was going to react. Same goes for DocuSign. Same goes for Cloudera, which reports after the close tonight. These are companies that I think are, setting up to go higher, but will they do it with their earnings report? Will we get a major gap up? I don't know. Walmart. Hey, don't overlook Walmart. Walmart all of a sudden taking off. 130 4 days ago. 147. I mean, that's a 13% rise in 4 days. Look at the volume coming in. Look at the AD line. Investors can't get enough of some of these companies. NVIDIA today had their target raised to 650. That's at 550. Haven't even looked at the pre-market, but let's see what NVIDIA is doing. Up another $32. A little smooth $32 action. Almost 6%. Another big day for NVIDIA. Hey, I'm on record talking about the market. Maybe it's going to pull back. You got to be a little careful in the short term with volatility index. Right now, the market doesn't care. But look at the volatility index rising while we're having these big moves to the upside. I mean, remember the VIX went up here, started to turn up right before that, right about the June 8th high. But I wouldn't be surprised to see another pop in the VIX if the market pulls back. But trying to time it, we do have historically a rough period of September coming up. Once you get past the 2nd of September, which is today, historically, that doesn't guarantee us it's going to happen this year, but historically, I can tell you that September tends to struggle once you get past the first couple of days. And it especially struggles from about the 18th, 19th to about the 26th, 27th. So later in the month could be when we see a pretty significant pullback, especially if some of these stocks keep going up and up and up. We're going to have so many in the money calls. It's going to be crazy. It might be a record. So later this month in September, I think we're going to have, at some point, we're going to have to pay the price for this straight up move. But trying to time it is very difficult. All right, one thing I wanted to show you is, how you can find, I talk about leading stocks and leading industry groups. So how do you find that? Well, one thing you can do is if we go into the relative strength industries and pull up the view all and hit the summary, and we go back maybe the last 3 months and check out the highest percentage gainers. I mean, you've got autos, you got non-ferrous metals, you got renewable energy, computer hardware, delivery services. See those 5 right there? Those are 5 leading groups. I don't have to guess. I've got this chart list, which in seconds tells me over the last 3 months, here they are. Here are your 3 winners, or excuse me, your 5 winners. And I'm going to jot these down just to make sure I get the right ones, because I'm going to show you what you can do with this. Pretty impressive. All right. So if I go back now to the home page or to your dashboard, go down to scans and type in new scan. I'm going to change this to 50-day, 300,000 average volume. Actually, I'll tell you what, I'm just going to get rid of all this because I'm going to pull up chart lists. I want to run a scan of the best performing industry groups within a couple of our chart lists that we offer our members. So let me just show you the first one, which let's got to pull up strong earnings. So I'm going to add that. That comes up here. And then I'm going to go into, let's just look at strong future earnings. We'll throw that one up there. All right. And so we got that. And then next, let's do these industry groups. So we got automobiles, add that one. We've got under materials, non-ferrous metals, add that. All I'm doing is going in and putting in the strongest industry groups over the last 3 months. Again, not a judgment, not my opinion. It's factual based on the industry groups and stock charts. Renewable energy, number 3. Computer hardware. Got to go down to technology. There's computer hardware. We'll add that. And delivery services, which is in the industrials. And add that. Okay. Now, one thing I have to do is I have to all right. So I have to put in another bracket here because I'm going to do ores. See, right now, if I run this scan the way it is, there are going to be no returns because you can't get a stock that's in automobiles and is also in non-ferrous metals and also is in renewables. No company goes into all the different industry groups. So what you have to do is when you start an or clause, you have to put in a second bracket there because that's starting the ors. So its group is automobiles or non-ferrous metals or renewable energy or computer hardware or delivery services, and then you have to have another bracket at the end. So it's looking at everything inside these double brackets as ors. Everything else is and. Okay. Now the other thing, what this is going to do is going to pull up any stocks from these 2 chart lists that are in any of these groups. But if I'm trying to get leading stocks in all these groups, and most of these should be leaders, but I can add a scooter. So let's add the scooter. And we can make it 90, or we can even make it 95. So it's got to have a scooter of 95 to even qualify. That's one of the top relative performers among its asset class. All right, so now I have a pretty good scan. I can hit the check syntax. It says it's good to go. And now I can run this scan. I mean, I'm kind of talking everyone through this, so it's taken me a little bit of extra time, but that's weird. did I do wrong here? Well, the market just opened. Let me try intraday. What the heck did I do wrong here? All right, well, I'm running out of time, so I have to revisit this and figure out what I've done wrong here. Something I've done wrong. Should be plenty. We could make it. Oh, I know what I've done. I've got and strong earnings and strong future earnings. There are no stocks that are in both of these chart lists. So this too has to be an or. So we're going to need a bracket there and a bracket there. Now check syntax. This should work. There we go. You want the best stocks. I mean, this is just an easy way to pull it up. But you want a list of the best stocks in the best industry groups. There you have it. These are 11 stocks right here that have been tremendous performers within leading industry groups. Now, does that mean they're not going to pull back? Sure, they can pull back. I'm just telling you, these are leading stocks and leading industry groups. And I just ran a scan. I mean, well, if I'd gotten it right the first time and wasn't walking everyone through it slowly, I could have done this in less than a minute probably, or maybe a minute. Using the tools and the products that we have at Earnings Beats, our industry group relative strength chart list, our two chart lists, strong earnings and strong future earnings, and then combining that with the scan engine, the power of the scan engine at stock charts, boom, just like that, 11 stocks. And without even hesitation, I could put those 11 stocks in. I mean, part of the problem is you got 4 renewable stocks, so it's not going to be very diversified. But maybe pick one from each of these groups and put them in, you know, a small little trading account and see where they are in a month. My guess is they'll be higher, but or maybe just do it on paper. Just follow what happens if I, you know, a lot of these stocks are pretty overbought. What would happen if I got in at this point? And look at what the market does. I mean, the other thing is to look at relative performance. I mean, if the stock market pulls back 20%, 10%, probably not going to, I don't think it's pulling back either one of those, but let's say the market pulls back 5%. Some of these stocks that have been going up, you're going to see profit taking. So these stocks might go down even more than 5%. But when the market starts moving higher again, money rotates back into the leaders. All right, not really a lot out in terms of earnings. There were a few companies out. I'll just pull the charts up real quick. H&R Block reported down after hours. I mean, look at, you know, this stock got no positive reaction. They did beat on their bottom line. They missed on their top line. Revenues came in light. But look at on a relative strength basis. First of all, look at the accumulation distribution line. Horrible. Look at price action. Look at where we were versus June. Look at the relative weakness in H&R Block. I mean, the market's telling you not to be in this stock. So you go through earnings and it's down 4%. As far as I'm concerned, you got nobody to blame but yourself if you hold these stocks. It's not that it couldn't go higher, but if the market is telling you that it is a major underperformer, there's normally a fundamental reason why. And we got it with earnings. They missed their revenues. Market's not impressed. How about Home? Now, this one's pulling back. Now, they beat top and bottom line. I didn't see guidance, but they beat top and bottom line. I actually think this move back to test the 20-day could be an opportunity. This is part of the specialty retail group, which is strong. This has been one of the leaders in specialty retail. And look at that AD line. Now, AD does not factor in today until the close. So this move higher doesn't factor in this big gap down, but we might have a hollow candle before the day's out. AD line might go even higher. All right, let's see. What else did we have? Oh, SCVL, Shoe Carnival. This is a smaller company, but I was interested to see how the reaction would be. Stock broke out recently, and if you look at the apparel retailers, I mean, this is a group that has been trying to move higher, hasn't broken out yet, but Shoe Carnival on a relative basis has been one of the leaders, and the volume has been picking up. So they came out, they missed on their revenues. They did beat on their bottom line, provided no guidance. The stock gap lower, but it is trying to turn back to the upside. This one's kind of a mixed, definitely mixed for me. How about one more? Macy's. Macy's came out, beat top line, beat bottom line, and the stock is moving higher to take out these recent highs. AD line, not very strong. And many times the reason for that is you get morning strength followed by afternoon weakness. Look at these tails at the top in August. This is how you get a bad AD line. You see the moves up, leaving tails, and then closing down in the bottom half of these candles. That will get you minus AD. So you want to see really high volume, and we got some serious volume in Macy's so far today, by the way. So if we can finish strong, you'll see a big jump in the AD line. But Macy's is one of those trying to make the breakout. It is fairly heavily shorted. So if we do make the break above those August highs, we could see a short squeeze on Macy's, no doubt about it. And I think eventually we're going to get that even on some of these companies that are beaten down because the economy is strengthening. Even the ones that were struggling throughout the pandemic, I think, bounce back. All right, let's go on and go through into the three you must see. Just a few quick charts. First, IR, which is Ingersoll Rand. Nice little bounce off the 20-day moving average. And off of this uptrend, I saw a little cup here. So I'm interested to see whether or not we make that breakout today. But if we do, we want to get some volume coming in. PVH, this is PVH Corp. Another one, look at it bouncing off that rising 20-day. Look back over the last, several attempts. When we go through the 20, we fail, basically can't hold on. Went back through in early August, couldn't hold on, move up. This time we pulled back yesterday, held the 20, and then we moved to a new high. I think this looks to me like it's maybe going to make a run for 70. And then the last one is Stitch Fix. Stitch Fix has been one kind of middle of the road. You got this move up, looks a little bit like a head and shoulder, but now all of a sudden yesterday on heavy volume, it looks to me like we're breaking out above that right shoulder. So this is one that's starting to show a little bit more bullish indications. AD line's just been kind of flat, not really showing a whole lot of anything. But if we can hold, and we need to hold, the rising 20-day moving average, I think Stitch Fix has a chance to maybe go up and test that July high. All right, that's it for today. I want to wish everybody a great Wednesday. Be back tomorrow over at Stock Charts for your next Trading Places Live. Take care, everybody. Happy trading.